Hi. As Jimmy Rogers says, buy low, sell high. And my Uncle John said, buy 'em when they're out of favor and sell 'em when they're popular. He claimed to rarely have sold a stock at a loss, but had been fortunate enough to have done much of his buying after the Dow had dropped 85%, forecasting the Great Depression. Nevertheless, these truisms are one and the same, and both beg the question, how do we know when a market is low or when it is high? There are numerous tools analysts use to address this problem. The one we have found most helpful is the combined short, medium, and long-term momentum of market prices presented in a way that allows easy comparison of today's market activity with significant past market turning points. In this presentation, we're going to explain the momentum position of the 6 major asset classes we follow. This slide shows the 75 markets we follow to make up those asset classes, which, as you can see, are global stock markets, currencies, money and bond market instruments, and both hard and soft commodities. For most of the stock markets, we use exchange-traded funds, which replicate the well-regarded MSCI indices in U.S. dollars. For those which do not have ETFs or ETFs with insufficient price history, we use other normally accepted indices. A major piece of Warner Financial Select's business is the continuous analysis of the momentum of these 75 financial markets. We look for markets that are oversold to buy and those which are overbought to sell. To help solve the are they really high or really low problem, we've programmed each momentum indicator with values that change when it does to fit within a scale of plus 100 to minus 100. Thus, it's mathematically impossible for a momentum plot to exceed these levels when overbought or oversold. This allows us to dispassionately compare the phase of present market conditions with those at significant past turning points. Taking this one step further, we produce a combined momentum plot. The combined plot weights short-term momentum at 20%, medium-term at 30%, and long-term at 50%. These weights are drawn from our view of the empirical evidence of how meaningful each indicator has been as a force affecting significant price change over time. At the beginning of every month, we publish Before the News, which uses this work in part to make buy, sell, hold recommendations on each market followed, and also ranks each market within its appropriate asset class. From that, we're able to produce pictures of the price momentum of all the asset classes, namely stock markets, bond markets, currencies, money market instruments, and hard and soft commodities. As you will see in the next few slides, this publication, Buy Low, Sell High, presents the condition of these 6 asset classes at the beginning of every month. This slide shows the history of the average momentum of all asset classes we follow, from early 2004 to the present. Short-term momentum is shown on as the dashed line, medium-term is the light solid blue line, and long-term the wider dark blue line. The dark navy blue line is the previously described combined plot of all 3 of these. Of course, most of these asset classes do not trade in tandem with one another, so none of the highest and lowest momentum plots in this picture, which combines the average score of all of them at the same time, has been near their maximum minus 100 or plus 100. Now the navy blue line is at about plus 40. This is as of August 1st. If we were closer to plus 60, that would mean that all the momentum series of the global markets on average would be as positive as they've managed to get at their peaks in the past 6 years. And we might expect that some event, such as an unexpected increase in interest rates, might be about to spoil the party. As Uncle John used to say, if the indicator were at 60, they've come into favor and it's time to look for some things to sell. Conversely, when the lines are down as they were in November 2008, it's time to look for things to buy. This is not a particularly important chart, for it doesn't look at one asset class we can buy or sell. Nonetheless, it gives us a general view of where all the market pressures are relative to where they have been in the past. Usually when these lines go down, things are tightening up all over the world, and when they go up, things are loosening up. When looking at these charts, please remember they are constructed by a person with the mindset of a pilot. All lines moving up are good, all lines moving down are bad. Now we'll look at the various asset classes. Here's a picture of the momentum of global money market futures prices. Again, up is good, down is bad, because money market futures prices are the reciprocal of money market interest rates. When these lines move up, it means that the pressure is for short-term interest rates to head down, which is usually good for other asset classes. When lines move down, the pressure is for short rates to rise, which is a sign that some caution is warranted. You can see that the lines bottomed out when short rates peaked in mid-2006 as the Federal Reserve started to take off the brakes and changed policy towards lower interest rates. Then, for the next several years, futures prices moved up and yields moved down, reaching a low point in February 2009. You can see then that the navy blue plot peaked near 100. At that time, short-term money market rates in the United States had moved down to about 0. Subsequently, the momentum dropped as the pressure for still lower rates backed off somewhat. Recently, the momentum of money market futures prices has begun to head up once again, indicating renewed pressure for short rates to stay low, if not go still lower, and signifying that monetary policy is even easier than it has recently been, which in historical context has been near record easy. We believe that a review of short rates is essential to understanding central bankers' monetary policies, which have a significant impact on the world economy and prices in all other asset classes. Bond prices, like money market futures prices, move inversely to their yields. Here you can see that bond price momentum on our scaling system tends to go from minus 100 to plus 100 quite regularly. The beginning of August 2010 is one of those times when the momentum of bond prices has been very strong, with the combined plot actually starting to correct a bit from a peak near 100. This chart follows the momentum of British, Canadian, Euro, Japanese, and U.S. government bonds. The momentum plot shows that government bonds are popular now, and though, as in 2007 and 2008, the momentum plot can stay up and bond prices be popular for quite a while, for those trying to optimize portfolio results over time, now may be a better time to be selling them than to be buying them. A better time to have bought would have been in the spring of 2007, 9, or 2010. What about stock markets? This chart shows the momentum of the 28 stock markets shown on the earlier slide, ranging from Australia and Brazil to Europe, the Far East, and the USA. While one might say, who cares about the Brazilian market, others might realize it's the 7th biggest economy in the world and growing quite rapidly, thus it's quite important. Another might say, who cares about the momentum of all these markets? I would say they tend to trade with a high degree of directional correlation, and from my days as a canoeist, I know it's easier to paddle with the current than against it. The green box on this slide depicts a period when the combined plot's post-range was mostly between 0 and 95. 0 is a rather neutral area, and 95, of course, is up near the max. This was from 2004 to 2007, when the markets were generally in a strong bull phase. The bottoming out of these markets in the fall of 2008 and spring of 2009, near the maximum weakness of minus 100, is clearly visible, as is their subsequent recovery back to a peak at plus 100. We're now into a period of renewed strength, though do note that the short-term plot is now at its plus 100 peak, Probably a time at least for some caution. This page shows the momentum of hard commodity prices such as aluminum, copper, gold, oil, and platinum. It shows a near maximum oversold condition in the fall of 2008. Clearly that was a time to look around for things to buy such as oil and gold. Recently this series has moved back down from a strong recovery period to a rather neutral position, but looks headed up again. Probably time to hold what one has left, if not buy more. Soft commodities, the term for a group made up of food staples like coffee, corn, cattle, pigs, soybeans, wheat, and sugar, generally go their own way, tending not to trade in sync with one another. But this plot can tell one if the momentum trend in general is favorable to hold them. It also shows that they were not a good place to hide as 2008 progressed. Finally, we're going to look at the momentum of the major foreign currencies versus the US dollar. In this presentation, up momentum means Forex is appreciating versus the dollar. Down momentum means the dollar is appreciating versus most Forex. Currently, at August 1, the combined general trend has recently bottomed out from favoring the US dollar to favoring foreign exchange. Combined momentum suggests it may not be too late to participate by being short the dollar and long Forex. I hope you've enjoyed this presentation. Though it's not designed to give you any specific buy-sell ideas, it is designed to give you a feel for where these various asset classes are relative to where they've been at extremes in the past and possibly guide your interests to and help you weight investments in these various asset classes. We're offering this monthly buy low, sell high slideshow free to institutional investors and certain friends and contacts. Should you wish to be on our mailing list to receive future issues, please click on the blue text on this page and sign up. Thanks for your time and good luck to you.